Hello, hello. This is Craig with Real Estate and Mortgage. Beyond the bank. I am here to help you. I'm here to teach you. I'm here to share some of the knowledge I've had over the last 32 years of doing mortgage loans. Today's topic I'd like to talk about is, there's a lot of clients out there that, for lack of a better word, think that, they talk to you on the phone and all of a sudden, you run a real quick pre-approval for them, and everything's great. Well, that is great because it shows typically that the lender is confident that you'll be able to qualify for a home or qualify for something that you're looking for. And 9 times out of 10, a client will already, or a buyer will already have a house or a price point in mind with a payment. A couple of things that I always like to do when I'm talking to a client. Whether they're referred to me, whether it's a lead online, or whether it's a friend, a neighbor, a family member that wants to do a loan. First off, I always want to ask them, well, what's your purpose? Are you going to stay in this house long term? Is this a short-term deal? Do you want this as a primary residence? Is this your forever home? There's lots of questions you can ask. Second thing, obviously, is you want to know, well, hey, how's your credit? And, a lot of people think that, hey, my credit, it's not the best. I don't know that I can qualify for a home. Well, as a broker, there are lots of lenders out there with a lot of really good programs that allow you to get into a home. They might not be the 2% Fed funds rate or something like that, which really doesn't exist as far as mortgage lending. And every client is different. Your credit score, your debt ratio, your strength of credit, and how long you've been on your job or something like that. All those play factors into what you're doing. Let's just say this. Standard qualifications are typically 2 months bank statements showing that you have money in there and you've saved some, and possibly where your down payment's coming from. 2 pay stubs. Why do I say 2 pay stubs? Well, 2 pay stubs is basically a month's worth of work. It kind of gives a full picture of, the kind of income that you're making. And many times we'll actually ask for a year-end pay stub from somebody that shows what kind of bonuses, tips, commissions, or anything else that they actually got throughout the year. Because a lot of times it's very important to qualify a client based on stable income. Stable income is what they normally, regularly are receiving, not just a one-time thing, maybe a $400 bonus that they got in March. Now, that bonus can be included as long as it's been received for over 2 years. So a lot of times we have to go back for 2 years to actually justify the fact that you did get a $400 bonus, and the year before that you got a $300 bonus. Average the two together, and that's your actual bonus that you get divided out over the 24 months. It's very interesting, and it's very not very intuitive to a lot of people. Case in point, I have multiple clients that they might work a part-time job, but they also have another part-time job. And on paper, they're actually making pretty decent money. But they've had one part-time job for about 1.5 years, and they've got the other part-time job that they just started 3 months ago. Well, of those 2 part-time jobs, I can only count the one that they've actually had consistently for about 1.5 years. Now, if that part-time job had been for 2 years and they consistently worked a part-time job for 2 years, and they went out and secured permanent or a primary job. So, for example, their part-time job might have been a server. They might have been, on weekends they would work, serving drinks or serving food or something like that. But they've consistently done it, and it gives them a little extra cash. But their main job is they work a 9 to 5 at some place, and that's their actual permanent full-time position. So in that situation, even though I have a permanent full-time position that hasn't maybe been very long, maybe it's only 90 days, I still can count the part-time income because it's been consistent for 2 years, and it consistently shows that you've been working 2 jobs. A lot of times people just think, whatever money you make is something that I can actually include. And per Fannie, Freddie, Ginnie, all the different entities that actually underwrite guidelines for loans, that's just not the case sometimes. What are the different categories of income? W-2 salary. Okay, a W-2 salary person is they work for a entity. That entity gives them a W-2, gives them an hourly wage. There might be benefits, there might be other things included with it, but that is a W-2 employee that they file their taxes off that W-2. What other categories are there? 1099. A 1099 is technically a contractor of an employer. So, for example, maybe there's a roofer that needs laborers, and they hire these laborers to come pound the nails into the shingles of the roofing, and they're considered a 1099 employee because they're a contract employee. A lot of construction is that way, and at the end of the year they give them a 1099. Typically, taxes weren't withheld, and they're on their own to pay those taxes. What's another form of income? Another form of income is possibly just the owner of a company. They own the company themselves. So maybe they have an S corp, maybe they have a C corp, maybe it's just a regular partnership off of their Schedule C of their income tax, which is a standard regular 1040 personal income taxes. And maybe the husband and wife have partnered, and that's how they run their income. A lot of buyers or a lot of people that actually have investment properties or rental homes actually do it that way. And obviously consult with your tax accountant, and they'll give you the best way to do that. You also have straight commissioned salespeople, whether they're actually W-2'd or whether they're a 1099. That is kind of a category where you do have to have a 2-year history, typically for Fannie Mae and Freddie Mac, to actually count that as stable income. That doesn't mean if you've been on the job for a year and a half and you've had commissions, 100% commissions the whole time, that we're not able to look at that and actually see that it's likely to continue and likely to be approvable. And with a very well-written letter of explanation from your HR department, 9 times out of 10, we're going to be able to use that income that you've been receiving as commission, even though it's less than 2 years. Because the guidelines are suggestions, not absolute deadlines. So that's one thing that you need to consider. A lot of people think that a self-employed borrower is the hardest borrower to approve. That's not necessarily the case also. Although a self-employed borrower, we typically need 2 years taxes, filed returns to count that income, because we show that as stable income over the last 2 years. Well, in the last 5, 6, 7 years, there have been multiple programs that have come out to actually help, for sale by owner, or not for sale by owner, my apologies, self-employed buyers to actually buy houses. There are multiple programs. And those programs sometimes are a stated income or a bank statement income. So for example, if I run a business and my business is actually getting receivables on a monthly basis, at times I can either take a 12-month or a 24-month average of the receivables that they receive on their income, or in their bank account, and multiply it by a factor, and that's the actual income that you're able to use and qualify for a loan itself. Now I'll just throw a caveat out with that. Typically, a self-employed borrower doing a bank statement loan is not going to get the same rate as a W-2'd client with an excellent credit score. Typically, they actually might get a pretty good interest rate, but typically the amount of down payment is typically going to be more, 10, 15% versus 5 or 10%, and as little as 3.5% on standard borrowers through FHA or Fannie Mae. So lots of good programs out there. There's all kinds of different programs. Another program is what's called a DSCR. DSCR is a debt service coverage ratio. What that means is if you're buying a house and you've got the appropriate amount of money down, typically 15 to 20%, you can buy investment property, and the only thing that counts for income on that property is the actual rents that will be received on the property. So for example, if the house is being able to be rented for about $3,000 a month, the mortgage payment ends up being $2,850 or $2,950 or even $3,000. Well, that's a 1-to-1 ratio, meaning my debt service coverage ratio, or my DSCR, is 1-to-1. Meaning if I can rent the house out for $3,000 and $3,000 is what I'm collecting in the rent, then I can be approved to purchase this house if I've got the appropriate down payment just based on the merits of the property itself. You still have to have a decent credit score. You still have to be paying your bills on time. But the only qualifications are the house itself, not your other income, not your other job or anything like that. So a lot of times that's a great way for a person to get an investment property, and it's qualified on its own merits instead of any of your income or debts for that matter. And that's usually the biggest thing, is the debts. Because a lot of people go out and buy a lot of houses, they have a lot of debts, and maybe their coverage ratio per guidelines aren't going to be enough, because typically we only allow 75% of your rent to go towards offsetting your payment. But on a DSCR loan, you're able to offset the current payment that you're buying the house for if you can rent it out for what that mortgage payment's going to be. So just a few tips, just a couple of things that I want to help teach and educate people on as far as lending. And we can go into these individually and break them down, but I just wanted to get a little video out here to tell you, of what is possible. Don't ever think that you can't be approved. Don't ever think that there's not a loan for you, because I promise you there is. It might not just be the one that you think you can qualify for, but there could be another one. Case in point, I had a friend that actually, was selling a house. He had a decent sized payment down. He ran he's self-employed. Unfortunately, there are tax loopholes. And, in order not to pay Uncle Sam more money, you take advantage of those tax loopholes, which are perfectly legal, and that's your right. But because of taking advantage of some of the tax loopholes and writing off a lot of income, the income that he was qualifying for was very minimal. So what did we do? Well, he had the appropriate down payment. We turned around and did a 12-month bank statement program. His business generated enough income and got a CPA letter giving us what his expense ratio was on a monthly basis. So we were able to use about 90% of the income as receivables and qualify him for the home based on that. With that and a very large down payment, he ended up with a very favorable interest rate, closed his loan, didn't take any longer than just your regular 30 days for, a standard loan, standard purchase contract. And the client was very happy with that. Anyway, what I'm trying to say is there's always a way to figure out how to get someone into a house and get a loan. So with that, I appreciate your time. Once again, this is Craig with RAM Real Estate and Mortgage, and we'll talk next time.